The Roth 401k or the traditional 401k? Which one's better for you? Let's take a look at some of the pros and cons. Hi, my name is Eric Blattner with Divvi Wealth Management, and thanks again for watching. And before we get into today's topic, first, I just want to remind folks that if you'd like to support the work we do, the best way to do that is to go over to our website. That's divviwealth.com, DIVVI wealth.com/blog. And there you can sign up to receive an email typically once a week or so where we talk about markets, financial planning, and a lot of different topics in between. Or you can go over to YouTube and subscribe, look for at Divvi Wealth Management, and subscribe to our channel there to be notified anytime we post a new update. So, with that being said, let's turn our attention to 401ks. And this video is really intended for anyone who works for an employer that has a 401k plan as a retirement saving option. And so, more and more people are now being faced with the decision of, do I want the traditional 401k or do I want to take advantage of the Roth option? And so we wanted to kind of unpack that and look at some of the pros and cons that might influence that decision and put you in a spot where your after-tax wealth is as high as possible. Because at the end of the day, that's really what we try to maximize. That's what we try to optimize for over time, is not just how much money you make, but how much money you get to keep after taxes. So with that being said, first, let's talk about some of the similarities between the Roth 401k and the traditional 401k. So the main thing that you're going to probably notice that the investments, the menu of choices that you have from an investment perspective, they're identical. It's exactly the same whether you choose the 401k or the Roth 401k or the traditional. So no decision point there. The amount that you can contribute from your paycheck, also identical. No difference between Roth and traditional. And employer contributions. There's no difference in how much, let's say, your employer makes a matching contribution. The amounts there are going to be identical as well. So from that perspective, there's a lot of similarities in the two plans. But if we start to think about how they are different, then that's ultimately what's going to help make your decision, right? That's why you care. So the first way that the 401 that the Roth and the traditional are different from one another is how those contributions are taxed to you, the investor. So traditional 401k contributions are basically a deferral. So that money goes to the 401k before you ever pay tax, before you ever really take receipt of it. So it comes from your employer and it's a direct contribution into the 401k with pre-tax money. So as an example, if you make, I'm going to use an example, there's a case study, a couple of case studies that we'll talk about in a little bit, but hypothetically, if you defer $24,000 a year, if you max out a 401k contribution, you're under the age of 50, then that's money that you will not be taxed on. On the Roth 401k option, it's a little bit different, and those dollars are considered ordinary income in the current year. So again, if you pay or if you make those maximum contributions, that's going to show up as income on your W-2 at the end of the year. And so typically when we fill out our tax reforms, if you look back at your 1040, you won't even see a line item there where it itemizes your 401k contribution because it's not reflected anywhere. It's already been deducted by the time you get your W-2, so it's not earnings in the current year. The other difference, or one of the other differences, so traditional goes in pre-tax. Roth, you'll be taxed on it each and every year that you're making those contributions. One of the other differences is when when you'll need to take the money out. And so the traditional 401k, depending on the year that you were born, historically it was 70 and a half. Now, there have been some legislation passed in recent years here that basically pushed those RMD beginning dates back a few years. So depending on when you were born, it will either start at age 73 or for those folks born after 1960 at age 75. So at that point in time, you'll have to start taking distributions from your traditional 401k, just like your traditional IRA. And the main reason for that is those dollars have gone in pre-tax. They've been growing, tax deferred, all these different years. And now the IRS is basically saying, okay, it's time to take some withdrawals so that we can collect some tax revenue from those savings. And the other thing to note is that if those dollars are made or those contributions are made entirely with pre-tax money, it's all going to come back to you as ordinary income. Now, when we think about the tax regime, the tax structure in the United States, there's basically a couple different tax rates that most folks will be subject to. There's the ordinary income tax rate, and then there's long-term capital gains qualified dividend tax rate. This is typically going to be the higher of the two rates. Right now, the maximum federal income tax rate is 37%, compared to the maximum long-term capital gain and qualified dividend tax rate is 20%. So it's a big difference between the two. So those traditional 401k dollars, when they are withdrawn, whether it's RMD or before RMD, it's all going to come back to you as ordinary income. Now, the Roth 401k, since those contributions have been made with after tax dollars, you can leave them in there forever. There will never be a point in time when the government is going to require you to take those distributions. So that's one of the primary differences between the Roth and the 401k. It's really a question of tax now or tax later. So when we start to think about the Roth or traditional in that lens, there's really a couple of assumptions that we think most folks are going to have to make when we try to analyze this decision. So the first decision point, or the first guesstimate, the first assumption that you'll need to make is around your income. Now, for young savers early in their career, where they have a reasonable expectation of growing incomes over time, the Roth option may look really attractive because, again, at lower income levels, it's likely going to be advantageous to pay ordinary income tax rates today while you're in these lower brackets, as opposed to waiting until you're in your prime earning years, in your 40s, your 50s, maybe your 60s. And generally, the expectation would be higher income, higher tax rates associated with that income. So to take advantage of that when you're younger, in your lower earning years with the Roth option could make a lot of sense. So that's the first assumption. Where is your income today, and where do you think it's going to be down the road? If you reasonably expect that income to be growing over time, then the Roth option might make a lot of sense. If you would expect your income may actually come down, if you're already in those peak earnings years, you're paying high tax rates, then maybe the traditional option makes more sense, where you can get a deferral today, avoid paying tax at a high rate, and hope that down the line you've got lower levels of income, lower tax brackets, and keep more of those dollars for yourself. Hopefully that makes sense. So that's the first estimate. The second piece that you have to make an assumption around is the tax rates. And for me, I think this is a very difficult issue to forecast. And for context, I'll show a chart here. This shows two lines: historical federal income tax rates in the United States going all the way back until the late 1800s. And what you can see really since the early 1990s, federal income tax rates, the highest bracket and the lowest bracket in the U.S., have been fairly steady. There's been a little bit of movement in there, but for the most part, the higher end of the range has been in the high 30s, and the lower end of the range has been low double digits, around 10%. Like I said, right now, the highest bracket is 37, the lowest is 10. However, I think it's perfectly reasonable for folks to say, I don't have any edge or any confidence in predicting what legislators are going to do with tax rates in the future. So I'm just going to assume the status quo. And I think that's perfectly reasonable. So take a look at where we are today. Yes, there's going to be some tax cuts that were instituted in the Trump era that are set to expire. So maybe we want to revert back to those pre-Trump tax levels. But regardless, if you want to assume status quo, and kind of take that decision point off the table, it seems perfectly reasonable to me. However, there's going to be plenty of folks out there that do have a strong opinion on the direction of tax rates. And to the extent that you're in that camp, then it can influence the decision that you make. So if you expect tax rates to rise significantly into the future, you would probably want to take advantage and pay a lower tax rate today with the Roth option. So if you have that Roth 401k option, you're going to pay tax today at today's federal income tax rates. If you defer until later and then you have to take those dollars out, either through required distributions or to support retirement spending, again, it comes out as ordinary income. So if you expect those tax rates to move considerably higher in the future and you choose the traditional option, you'll probably be paying higher tax rates when you spend those dollars. Hopefully that makes sense. And then lastly, of course, if you expect the opposite to happen, if you expect tax rates to actually fall into the future, then you would probably want to defer until a later date when tax rates are going to be lower and choose the traditional option. So if you expect tax rates to rise in the future, you would probably want to take advantage with the Roth option, pay tax today. If you would expect tax rates to fall in the future, you might want to defer with the traditional option today, pay taxes at a lower rate down the line. Again, hopefully that makes sense. And then the last piece that you'll probably need to make an assumption around is when you need the money. And so for some folks, they don't ever want to spend it. And they like the idea of being able to let those dollars accumulate into perpetuity. And the Roth option is the only option that's going to allow you to do that. Again, with the traditional 401k, at a certain age, whether it's 73 or 75 years old, you'll be required to start taking those distributions. And that's all going to come back to you as ordinary income. So again, if you are already expected to have enough retirement income to support your spending needs, you may not want the money, you may not need the money. That might be a little bit of a nudge in the direction of the Roth, either behaviorally or because the math makes sense. Again, we're dealing with forecasting assumptions, so that makes it a little bit fuzzy. The crystal ball is always, well, it feels foggy most of the time, but this is one area where, kind of the behavioral aspect, it's important to kind of take that into consideration as well. We mentioned RMDs when you're going to need the money, so I wanted to put a real life example around that for folks because if you're like me, I'm in my early 40s right now, and mid 70s seems like a ways away, but I wanted to give an example. And so here's a scenario, and we're going to talk about a few case studies. The first is going to be like a mini case study, a real world example around required minimum distributions. And we're going to start by assuming that someone has a 401k with around $500,000 in it today. They're going to make annual contributions of $24,000. They're going to earn about 6% per year on those investments, and they're not going to take any distributions whatsoever until they reach age 75. So at that point in time, they're going to be required to start taking some of those distributions, and the 401k will have grown to about $3.6 million based on these assumptions. At that point in time, based on the uniform life tables, this is a couple that is married, filing jointly, that individual should expect to have to take a required distribution of about $150,000. So 150 grand that you're going to be required to take, again, all coming out as ordinary income. So if you've already got a decent amount of income, you very easily could be talking about 24, maybe 32% in federal tax on those dollars, kind of depending on what the rest of your retirement income looks like. And that number just continues to grow, assuming the account grows for at least the first few years. So that's an example of what folks might expect in that specific situation. And of course, we can model things out for individuals to kind of get a clearer picture for folks that are interested in that. The last thing that I want to mention is this concept of tax diversification. And I think for a lot of folks, when we think about Roth versus traditional 401k, it's really hard to predict some of these variables accurately. You may have a pretty good feeling today that your income is either going to be higher or lower. You may have a fairly strong opinion about tax rates, whether they're going to be a little bit higher, a little bit lower, or close to the same. And you may understand exactly when you need to use that money. But for a lot of folks, it's really cloudy, and that's okay. And so for a lot of folks, the right answer is going to be some of both. And it's a little bit of a hedge on um, on higher taxes down the line, or even lower taxes down the line. What do I mean by that? And so hypothetically, if you've got a family or a saver that's going to divide those 401k contributions between Roth and traditional plans, you're basically acknowledging that I can't predict the future, but I want some optionality. I want to have more choices when I enter those retirement years. There may be some years when your income is low, and it makes a lot of sense to take distributions from that traditional 401k, knowing it's all going to be taxed as ordinary income. But if your income's already low, you might be taking advantage of really low tax rates. On the other hand, you might have other years where income levels are really high. And if you've got an opportunity to withdraw retirement spending dollars from a Roth plan, you can avoid paying tax in years when those income are are higher and tax rates are higher. So hopefully that makes sense. The idea of tax diversification, having options, having choices, for a lot of folks helps them sleep at night. It also opens up the door for an investment concept that we call asset location. And um, one of the things that we do when we're building investment portfolios, you have to make forecasts. You have to make assumptions about which investments, which pockets of the market do you expect to grow faster, which areas do you expect to grow lower. And generally speaking, again, if we're trying to maximize after tax wealth for individuals, we would love to stuff the Roth options with higher growing investments, all other things being equal, because those dollars have already been taxed and we get to take those out tax free. So if we can grow that pile as big as possible, that's a that feels like a win. The taxable side, however, perhaps you're in a situation where an asset allocation calls for a certain amount of fixed income. Well, since those dollars are all going to be withdrawn as ordinary income, it might make more sense to tilt that side of your 401k investments more towards the conservative or slower growing investments, or those that are going to be taxed as ordinary income anyway. So this asset location concept we've talked about a few times in the past, but having options where you've got traditional 401k, which we call a tax deferred bucket, Roth 401k, which is more of a tax free bucket. And then if you complement that with a third bucket, which is what we call just a taxable sleeve, can really open up the optionality, the choices that folks have for supporting their retirement spending in the right scenarios. So we will spend a few minutes walking through a couple other case studies in a bit. But before I do that, I just want to remind folks that, again, if you'd like to support the work we do and want to follow along, the best two ways to do that are go over to our website, divvywealth.com, and sign up for a blog there where you will receive typically one email a week when we write about some of these topics. Go to YouTube, search at Divvi Wealth Management with Divvi Wealth Management, pardon me. Subscribe to our channel there to get notifications anytime we upload stuff. Or, of course, reach out. There will be a link in the description of this video here that tells you how to get in touch with the Divvi team if you have any interest in continuing the conversation or speaking with us about your situation. By all means, please reach out. So thanks again for watching, and we'll turn to the case studies here in a few. Thanks. Bye-bye. All right, so let's spend a little bit of time now walking through a couple different case studies. And we really wanted to kind of show you a couple of examples from opposite ends of the spectrum. So we're going to start with a young saver who's probably in the earlier stages of his career and expecting to see that income rise over time. And then after that, we're going to spend a little time looking at a higher earner, probably mid-career, not quite peak earnings, but maybe close, and seeing those different scenarios all through the lens of Roth versus traditional 401k. So again, as a reminder, this video is really for people who are trying to make the decision. They've got options from their employers around the 401k and trying to make a smart decision as it relates to traditional or Roth. The other thing we'll note is that this is for educational purposes, not intended to be financial advice. So keep that in mind as you're evaluating your own personal situation. So to get started, let's start with that first scenario that we're going to call the young earner. And I'm going to start by reading off some of the assumptions that we use. First, this individual is 25 years old and filing taxes as a single filer. The beginning 401k balance in both scenarios is $20,000. Annual income of $120,000 with inflation of 3% per year. So that income is going to rise to keep up with inflation by 3% per year. And this individual's monthly expenses are $6,000. per month. So why does that matter? As we will see in the retirement years, we're going to assume that the retirement spending is roughly the same as when it was working, and so we're going to need some of these retirement assets, the 401k dollars, whether they're traditional or Roth, to support some of that retirement spending. We're going to assume the employer matches 100% of this person's contributions up to 3%. And then anything that's left over at the end of the month, if there's excess cash flow, we are going to assume that money is spent. Now, obviously, you can do different things with that money. You can travel, you can consume. There's lots of different ways to spend. You can give. Of course, you could save. There's plenty of folks that would probably explore Roth IRAs or taxable brokerage accounts. In our scenario, to keep it simple, though, we're going to assume that those excess monthly dollars, not used, not spent, that they are um, uh, that they're essentially spent as well. So not saved, not applied toward the retirement spending in any way, shape, or form. So that's the punchline. So with all those assumptions out of the way, let's start by taking a look at the first chart here. And we wanted to look at a couple different milestones. So we're going to show you examples, not year by year necessarily, but with a couple big milestones. We're going to start at age 25, as I mentioned, and then show you how things are progressing at age 45, age 67. Why age 67? Because that's the age when, pardon me, when this individual will reach full retirement age and start to receive Social Security. And then finally, the last milestone that we'll use is age 85. So you see all those ages on the bottom horizontal axis. And there's two groups, the traditional 401k option, and then there's the Roth 401k option. And so we wanted to apply a couple different perspectives. The first thing that we wanted to consider is, again, the income. So you'll see the dark green bars, and that shows this individual's income rising over time, and it's the same in both scenarios. So regardless of Roth versus traditional 401k, income is the same. Next, the light green bars. Those are the annual taxes paid. So again, not cumulative. These are annual taxes paid at these four different milestones. And you will notice that choosing the traditional 401k option results in lower taxes paid in those early years. Age 25, age 45, age 60, actually age 67 is it starts to flip, but those first two milestones, and if we were to show you all the different steps in between, you would be paying less tax in those early years because you're choosing the traditional 401k option. Your contributions are going in before tax, and you're getting to defer that income to a later point in time. The Roth option is being funded with after-tax dollars, so that's going to show up as income that's going to be taxed in the current year. So as an example, if you look at that age 45, the total tax paid was $67,000 under the traditional 401k option, and it was over $71,000 for the Roth 401k option. As you start to progress, though, you'll notice, particularly toward those later years, the tax paid is considerably higher for those traditional 401k scenarios. We'll talk about that in just a second. So then if we look at those dark bars, the black bars on the far right-hand side of the page, those represent 401k distributions. So we're going to assume at some point you're going to need to draw this money down to support your retirement lifestyle, to support your retirement spending. And so if you look at that age 85 milestone, you'll see that there's $290,000 being distributed from the 401k. Now, why $290,000? You probably don't need that much to support your spending. Well, in this case, we talked about required minimum distributions, and this individual is well past age 75 when those RMDs are expected to begin. So at age 85, based on the 401k account balance, it's estimated that that individual will be required to withdraw $290,000 from the 401k. Again, all of that is going to show up as ordinary income. That's why you have $98,000 in tax paid at age 85. Compare that to the Roth option, and you'll see that there were only $68,000 in distributions. And Why 68,000 instead of 290,000? It's pretty simple. With the Roth, you are not required to make distributions. You can leave that money in the Roth 401k for as long as you'd like. So we're only going to take as much as we need to support that retirement spending. Everything else is going to remain in that Roth 401k. And as you can see, taxes are considerably lower at $14,800, generally coming from Social Security tax or the tax on your Social Security income. So that's the first scenario. I want to show you a couple more charts related to this miniature case study, and this is going to show you the 401k balances. Now, you'll notice that those first three milestones, they're identical because we assumed that the investors have the exact same investment options. They're allocated exactly the same way, and the same amount of money is being contributed to the 401k at the same time. So those balances are the same. They really only change once RMDs start to kick in, those required distributions. So if if you look at that age 85 milestone, you'll see that if the individual that went with the traditional 401k their entire career, at that point would have about $5.4 million left in their traditional 401k. The Roth 401k, again, because they can leave that money in the account, has grown to about $7.8 million. So considerably more assets left in the Roth 401k at the end of the plan. And then two more charts. This is going to be a chart that shows the cumulative tax paid. This is over the course of this individual's life. And you'll notice for those first, 10 or 12 examples, age 25 through 75, I'm using 5-year jumps here. And the Roth option would generally have that individual paying more lifetime tax up until about the early 70s, right in that ballpark. That's when it essentially flips. And then because with the traditional 401k, we are going to be required to take those distributions after age 75, you will see that those cumulative lifetime taxes really start to favor the Roth option when looked through that lens. So if you look at the very end of the plan at age 85, it's about $4.4 million that's been paid in lifetime tax with the traditional 401k compared to around 3.6, 3.7 for the Roth option. So considerably less over a long period of time with the Roth. And then finally, I want to talk just 1 minute more about these excess cash flows. So we already mentioned the idea that if the money is not being used for expenses, then the assumption right now is that those dollars are spent on cars, clothes, charitable contributions, travel, concerts, who knows? But we're assuming that those dollars are spent. Now, of course, that doesn't have to be the case. So some individuals may prefer to invest those dollars elsewhere, and that's not going to be reflected anywhere in these numbers. So what you will see, these cumulative excess cash flows at age 65 total about $1.5 million for that traditional 401k option compared to call it around 1.35, almost 1.4 million in excess cash flows for the Roth option. So you would have more money to invest elsewhere with the traditional option. I just think it's worth noting since that's not being reflected in the plan, and it could have depending on how those dollars are invested, could have significant impact on the outcome. So just keep that in mind. There's always nuance to the stories in these case studies in particular. You can show a lot of different scenarios, and I just want to call out some of the main assumptions that we used that really influenced the results. So that's the first case study looking at a younger investor. We're going to take a quick break here to set up set the stage for the second and final case study. Be back in a second. Thanks. All right, thanks for hanging with us. We've got one more quick case study that we're going to go through, and it's going to be basically the same format that we just used, so hopefully this should go a little bit quicker. So let me start by throwing the assumptions up that we're going to use here. In this case, we've got a 45-year-old household, and it's a couple that files married, filing jointly. They've got a beginning 401k balance of $500,000. And importantly, we're going to assume that's going to be traditional 401k in both scenarios. So the beginning balance is 500,000 in traditional 401k assets with an annual income of $500,000, monthly expenses of $15,000, and again, 3% inflation. It's going to affect both of those numbers, income and expenses. And then we're going to assume this individual is maxing out the 401k contributions and still getting 100% match on that first 3%. And then the excess cash flow, anything above and beyond their normal expenses, is also spent, not saved. That's going to be, those are the primary assumptions that are going to drive this output. So let's start with that first chart that kind of outlines those different milestones through the lens of income taxes, distributions, and excess cash flows. So starting off with those dark green bars, you can see the income levels and how those continue to rise between the ages of 45 and 67 years old, and the associated taxes with that income as well. So again, those light gray bars will be higher for the scenarios where they opt for Roth. Why? Because those Roth contributions are made with after-tax dollars. It's going to show up as taxable income. Your traditional 401k is going to be deferred. You're going to defer that income to a later year and contribute those assets to a traditional 401k. So example, look at age 55, that milestone, you'll see the tax on the traditional 401k example is about $199,000. And for someone in that same situation who opted for the Roth 401k would pay about $213,000 or about $15,000 more in income tax in that specific year. So you can look at the chart left to right and see kind of how that plays out over time. Next, look at the 401k distributions. That's the dark bar. And it specifically shows up at the 75 and 85-year-old milestones. At these, again, the traditional 401k is subject to required distributions, and that's what's going to be reflected, at least to a certain extent, in those charts or in those columns. So at age 75, you're going to assume $294,000 is withdrawn to support retirement income, and the tax associated with that, because it's traditional 401k and it all comes out as ordinary income. The tax in those later years is going to be considerably higher, and in this case, it's almost $92,000. You compare that to the Roth scenario, and again, with the Roth 401k, we're not required to take any money out. We're only going to use what we need in order to support our retirement spending. So we're going to take out a little bit less, $235,000, and the tax in this case is almost a full $60,000 less in those later years at age 75 because of the Roth option. And you can see how that plays out at age 85 as well. The last thing, those brown bars, the excess cash flows, we'll spend a little bit more time on that here in just a minute, but important to note that with the traditional 401k option, the excess cash flows that we assume are spent are much greater with that traditional 401k scenario compared to the Roth scenario. So we'll take a closer look at that. Now let's take a look at what's left in those 401k balances. So again, you should notice that at ages 45, 55, and 67, there's no difference. We're assuming that those portfolios are invested exactly the same way, basically 2/3 stocks, 1/3 bonds. And we're using a blend of capital market assumptions that I won't bore you with, but the investments are exactly the same in both scenarios. The contribution rates are exactly the same in both scenarios. So the account balances are exactly the same in both scenarios. The only thing that you'll have to remember is that in that Roth scenario, it's actually a mix of traditional and Roth assets, because we assumed at the beginning that those $500,000 401k assets were all traditional. So that's at the beginning. We've been adding to the Roth ever since from age 45 on. So it's a blend. You've got both of those 401k options available to you. So basically what you see here is at age 75 and 85, the Roth IRA assets are considerably higher, again, due to the required distributions that you need to take from the traditional 401k that aren't required in the Roth option. So to the extent that that matters, and that's important, having some type of a legacy perhaps to pass on to others, then in this situation, the Roth would, at least through this lens, be a little bit more attractive. Next, let's take a look at the cumulative tax paid. And again, in this situation, you'll see basically a flip between ages 70 and 75, where all of a sudden the traditional option starts to become a little bit more expensive from a tax perspective. And the main reason for that is even in retirement, this individual still has, or this couple still has substantial income. So it isn't like they're going from a 37% federal income tax rate all the way down to 24 or 22 or 12. They're still going to be paying a pretty considerable tax rate. So um, the cumulative tax paid over time, again, if you look all the way out to ages 75, 80, and 85 years old, in these cases it's higher for those traditional 401k assets. And it's, again, primarily due to some of the required distributions that have to come out of that traditional 401k. And those all come out as ordinary income. And then the last thing I wanted to mention were those cumulative excess cash flows. This is the one piece that I think is really interesting in this scenario. We've got substantial excess cash flows in um, the traditional 401k option. And so basically what we were looking at, again, if you look at age 70, you've got almost $4 million compared to only 3.5 that had been spent, consumed, vacations, travel. Who knows exactly how that money was spent. On the flip side, this scenario does not show what would have happened had you decided to invest those excess dollars in something like a taxable brokerage account, where you could have been investing for the last 20, 25, 30 years in some type of growth oriented, tax efficient vehicle. Like that's not going to be reflected in any way, shape, or form here. So that's an important caveat to keep in mind. Understand yourself, your behavioral tendencies. If you have excess money, what are you likely to do with it? Are you more inclined to spend it and have some fun, or you're more inclined to save it for later? So those are all different things that can influence a decision, Roth versus traditional. And hopefully these case studies have been helpful. There's one final one that we really didn't spend any time on or we didn't put together, but that's the blended scenario, where, again, I think a lot of folks that are kind of on that borderline or have a tough time forecasting exactly what the income is going to look like or exactly what they think tax rates are going to look like. In a lot of cases, that blended option might help you hedge your bets, so to speak. So we'll stop there. Again, if you have any questions, please reach out to us. Or if you want to see what these scenarios might look like for your specific situation, we'd love to have that conversation. So you can reach us at the link in the description below, or you can always follow us at divvywealth.com, DIVVI wealth.com, or subscribe at YouTube. It's at Divvi Wealth Management. Again, thanks for your time, and please reach out if we can help. Have a good day. Bye-bye.